On a summer night in August 1971, the President of the United States quietly broke a promise the entire world was built on. In just a few minutes on television, without a single vote from Congress and without asking any other nation's permission, he changed what money meant. For everyone, everywhere, most people alive today have no idea it even happened. Yet every price we pay, every mortgage we sign, every crisis we fear, all trace back to that forgotten announcement. And as the world sleepwalks toward another financial crossroads in 2026, the echoes of 1971 are growing louder than ever. This is Hidden Finance, where we dive beneath the headlines and into the decisions that quietly rewrote the rules of money. In this episode, we're going to travel back to the moment the global monetary order snapped, uncover why almost no one talks about it, and explore why a new shock different in form, but similar in scale may be approaching in 2026. This is not a prediction of doomsday, and it's not financial advice. It's a story about power, promises, and what happens when the math behind our money no longer works. Because to understand the next shock, we first have to understand the last one the world chose to forget. To see why 1971 mattered so much, we have to rewind to a very different world, the ashes of World War II. In 1944, as the war was still raging, 44 allied nations met in a small New Hampshire town called Bretton Woods. Their mission was simple but enormous: design a system that would prevent another Great Depression, another currency war, another slide into chaos and fascism. Out of that meeting came a grand bargain: the Bretton Woods system. The United States dollar would be anchored to gold at a fixed price of $35 per ounce. And every other major currency would be anchored to the dollar. In practice, this meant that foreign central banks could turn in their dollars to the US Treasury and get real gold in return. Gold was the ultimate anchor, the promise that paper money was not just ink and trust, but a claim on something real. The new system created institutions like the International Monetary Fund and the World Bank, and for a while, it worked astonishingly well. The 1950s and 1960s became an age of rapid growth, rebuilding, and rising living standards across Europe, Japan, and the United States. But beneath the surface of this golden promise, a quiet tension was forming. A tension that would take nearly 3 decades to explode. At the core of the problem was something economists later called the Triffin Dilemma. For the world to use dollars as its primary reserve currency, the United States had to supply those dollars by running trade and budget deficits, sending its money abroad. The more prosperous and interconnected the world became, the more dollars it needed. But every dollar issued by the US government was, in theory, a promise, a claim that could be converted into gold at a fixed rate. Slowly but surely, the world was accumulating more paper promises than the US had gold to honor. By the 1960s, this quiet imbalance had turned into a looming crisis. The United States was trying to fight a costly war in Vietnam and fund expansive social programs at home, a combination famously described as guns and butter. Spending soared, deficits grew, and more dollars poured into the global system. Meanwhile, countries like France began to question whether those pieces of green paper were truly as good as gold. French President Charles de Gaulle openly doubted the system and began exchanging dollars for physical gold, shipping the metal out of American vaults and back to Europe. From 1958 to 1971, U.S. gold reserves steadily drained as foreign governments tested the promise at the heart of Bretton Woods. At the beginning, the United States held more than half of the world's official gold. By the late 1960s, that dominance had been eroded. While the quantity of dollars held abroad had exploded, the math was becoming undeniable. If too many countries showed up at once and said, "We'd like our gold now," the US would not be able to deliver. The gold window was still open on paper, but in reality, the system was already cracking. In 1968, attempts to stabilize the price of gold in international markets began to fail. A group of major central banks known as the London Gold Pool tried to defend the official price, selling gold into the market to keep investor speculation under control. But demand surged, confidence wavered, and the pole collapsed under its own weight. A two-tier system emerged, an official price for governments, and a higher market price for everyone else. That gap was a flashing red warning light that the old system was dying. By 1971, the pressure had become unbearable. Germany and other European countries were letting their currencies float rather than keep defending the fixed link to the dollar. Speculators and central banks alike began to bet that the dollar would have to be devalued or that the whole gold convertibility promise would be abandoned. In early August, large volumes of dollars were being converted into gold, draining U.S. reserves day by day. Something had to give, and it was going to give fast. On the weekend of August 13, 1971, President Richard Nixon convened a secret meeting at Camp David with his top economic advisors. Inside those closed doors, a small group of men debated the monetary fate of the world. They weighed a few options: devalue the dollar against gold, tighten belts and defend the existing system, or end the gold convertibility entirely by Sunday. They had made their choice. That evening, Nixon went on national television and delivered what sounded like a routine economic address, but turned out to be one of the most important financial speeches in modern history. "I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets," Nixon said calmly. To most ordinary Americans, it was just another political sentence buried among talk of inflation and jobs. But for central bankers, finance ministers, and anyone who understood the plumbing of the global monetary system, it was an earthquake. The United States had just defaulted not on a bond payment, but on its promise to trade dollars for gold at a fixed rate. The word temporarily would become one of the most expensive adverbs in history. Overnight, the Bretton Woods system was effectively dead. At first, countries tried to salvage something from the wreckage. In December 1971, the world's major economies signed the Smithsonian Agreement, attempting to realign currencies and keep a version of the fixed-rate system alive. But the underlying problem hadn't gone away. There were still too many dollars and not enough gold, too many imbalances and not enough trust. By 1973, the experiment was abandoned, and the world's major currencies were allowed to float freely against one another. This was the true 1971 shift. The world left behind a money system anchored, however imperfectly, to a tangible asset, and entered a new era of pure fiat currency. From that moment on, money was no longer a promise to deliver gold. It was a promise based only on laws, central bank policies, and collective belief. Governments could create more of it without digging a single ounce of metal out of the ground. Central banks could cut interest rates, expand credit, and rescue financial markets in ways that would have been impossible under a strict gold standard. For better or worse, the leash between money and the physical world had been cut. The consequences of that decision unfolded over decades, shaping a world most of us grew up assuming was normal. In the 1970s, the immediate impact was painful: oil shocks, inflation, and the phenomenon of stagflation, high prices and weak growth at the same time. OPEC's decision to price oil in dollars and restrict supply sent energy costs and inflation soaring, while the new floating exchange rates made global trade more volatile. By the early 1980s, Federal Reserve Chair Paul Volcker responded by driving interest rates to brutal levels, crushing inflation, but also triggering deep recessions. The medicine worked, but it left behind a new pattern. Every crisis would be answered with more debt, more financial engineering, and more reliance on the flexibility of fiat money. As the old gold anchor faded into memory, a new era of financialization emerged. Banks, hedge funds, and corporations discovered that in a world of floating currencies and central banks willing to provide liquidity, credit could grow faster than ever before. Deregulation in the 1980s and 1990s removed barriers, derivatives markets exploded, and financial assets began to balloon compared to the real economy. If you chart productivity and wages in the United States, You can see a curious divergence beginning in the early 1970s. Worker output keeps rising, but median wages flatten. Meanwhile, asset prices from stocks to real estate begin a long climb upward, turbocharged by cheap and abundant money. The crises of this new system became increasingly violent. The Latin American debt crisis of the 1980s, the Asian financial crisis of 1997, the dot-com bubble of 2000, and the global financial crisis of 2008 were all, in some way, children of the post-1971 order. Each time, the solution involved cutting interest rates, expanding central bank balance sheets, and pumping more liquidity into the system. After 2008, the term quantitative easing entered the mainstream, central banks buying government bonds and other assets in massive quantities to keep the system afloat. After 2020, during the pandemic, the money creation reached levels that would have been unthinkable in the Bretton Woods era. The world kept functioning, but at a cost. Global debt, governments, companies, and households combined climbed past $300 trillion. Asset prices surged far faster than incomes, pushing homeownership and investment out of reach for many, while making the wealthy far wealthier. Currencies no longer collapsed because of gold. They wobbled under the weight of trust, politics, and central bank credibility. The system became more flexible and also more fragile. And that brings us to 2026, the year many economists and historians quietly circle on their calendars, not as a mystical date, but as a dangerous convergence point. Unlike 1971, there is no single international treaty or gold promise to break this time. Instead, there are several slow-burning fuses all moving toward the same moment. On their own, each might be manageable. Together, they could force another silent, sudden rewrite of the rules. To see why, we need to follow the threads Nixon's decision set in motion, all the way to the present. First, there is the debt. The post-1971 world made it easier to grow government borrowing because money was now a policy tool, not a scarce physical resource. In the United States, federal debt has surged past $34 trillion, and interest payments are now one of the largest line items in the budget. Much of that debt was issued when interest rates were near zero after 2008 and 2020. By the mid-2020s, including the year 2026, a huge portion of those cheap bonds must be refinanced at today's much higher rates. That rollover is not a calendar event with a single date, it's a wave. But around 2026, the wave begins to crest. The government will either have to accept much higher interest costs, cut spending, raise taxes, or rely on its central bank to help in ways that echo the money creation of the past decade. None of those choices are politically easy, and each has consequences: inflation risk, social unrest, or lost confidence in the currency. A world built on ever-expanding debt is quietly running into the limits of its own assumptions. Second, there is a fiscal time bomb baked into the law itself. In 2017, the United States passed a sweeping tax reform bill that cut taxes for individuals and corporations, but was never fully paid for. Many of those tax cuts are scheduled to expire at the end of 2025. That means that, starting in 2026, unless new laws are passed, millions of Americans will face higher tax bills at the same time the government's interest costs are rising. Congress will be forced to choose between extending the cuts, blowing a bigger hole in the budget, or allowing a sudden fiscal tightening in an economy already strained by higher rates and higher prices. Third, the social promises that defined the post-war era are under pressure from demographics. Programs like Social Security and Medicare in the United States were designed for a world with more workers and fewer retirees. But populations have aged, birth rates have fallen, and benefit commitments have grown. Trust funds that back these systems are projected to face serious shortfalls in the 2030s, but the political reckoning starts well before the money runs out on paper. By the mid-2020s, debates over entitlement reform, retirement ages, and benefit cuts become not just theoretical discussions, but immediate fiscal necessities. Then there is the technological shift, one that perhaps most closely mirrors the invisible nature of the 1971 change. Around the world, central banks are exploring and piloting central bank digital currencies, or CBDCs. From China's digital yuan to Europe's digital euro project and experiments at the Bank for International Settlements, the next version of money is being coded, line by line. By 2026, many of these projects are expected to move from theory and small tests toward broader implementation and real-world integration. Just as 1971 quietly severed money from gold, the second half of the 2020s may quietly sever money from its analog past, replacing much of it with programmable, trackable, digital cash. This shift could bring efficiency and faster payments, but it also raises profound questions. Who controls the code that defines your money, and under what conditions can it be frozen, taxed, or reprogrammed? In a crisis, fiscal, financial, or political, how tempting would it be for governments to use digital currencies to impose negative interest rates, targeted stimulus, or spending restrictions? The combination of historically high debt, political polarization, and new digital tools creates a landscape in which the next Nixon moment might not involve a TV speech about gold. It might arrive as a quiet software update to the operating system of money itself. Overlay all of this with rising geopolitical tension, and the parallels to the late 1960s and early 1970s become harder to ignore. Then, as now an existing empire than the United Kingdom, now the United States was grappling with costly foreign commitments and domestic unrest. Today, rival powers are actively seeking to reduce their reliance on the US dollar. From BRICS discussions of alternative payment systems to bilateral trade in local currencies, the exorbitant privilege of the dollar is slowly being questioned. The world doesn't need to fully abandon the dollar for a shock to occur. It only needs to doubt that the current rules will last. So what could actually happen around 2026? It may not look like the drama of 1971, with the president suddenly suspending gold convertibility. Instead, we might see a coordinated reset of fiscal rules, tax regimes, and central bank frameworks designed to manage unsustainable debt. We might see the formal rollout of digital currencies as a tool to better target monetary policy in a stressed financial system. We could witness a major confidence event in government bonds, perhaps triggered by a recession, a political crisis, or a market revolt against high deficits that forces rapid policy changes over a single weekend. Just as in 1971, or, like many turning points in financial history, the shock might not even be recognized as a single moment until much later. Just as few people remember Nixon's Sunday night speech, many might not recognize the importance of a law passed in 2025 or a monetary framework updated in 2026 until its consequences echo through prices, wages, and savings for decades. The real lesson of 1971 is not that gold was perfect or that fiat money is evil. It's that when a system's promises can no longer be honored under the old rules, the rules change, and they change fast, usually under pressure, and almost always without a public vote. Those who understand what's happening are rarely the ones watching television that night. For ordinary people, the stakes are simple and brutal. In 1971 and the decades that followed, savers who trusted their currency and held cash or fixed incomes often saw their purchasing power erode. Those who owned real assets, businesses, real estate, commodities, productive skills fared better in a world of inflation, currency swings, and credit cycles. The gap between the financially literate and the financially exposed widened dramatically. As the next shock approaches, that divide is likely to grow again unless people understand the game they are actually playing. The story of 1971 is not just about gold, Nixon, or obscure international agreements. It is about how quietly the ground beneath our feet can move, and how entire generations can live inside a system they never chose, shaped by decisions they never heard. The coming years, and especially the mid-2020s, may mark another such shift, not necessarily a collapse, but a transformation in how money, debt, and power interact. In that sense, 2026 is not a prophecy date, it's a mirror, reflecting back the unresolved tensions of the world Nixon helped create. What we do with that reflection will determine whether the next shock becomes a catastrophe or an opportunity to build something more stable. You've been watching Hidden Finance, where we uncover the quiet decisions and forgotten turning points that still rule your wallet today. If this journey through 1971 and the possible shock of 2026 made you see money, debt, and power a little differently, then the story has done its job. Stay curious, stay skeptical, and never assume the rules of the game can't change, because history shows they always do, and they usually change when most people aren't looking. This is Hidden Finance, reminding you that in the world of money, what you don't see is often what matters most.